Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And so let's get into today's Q&A session, and we'll begin with a question from Tim. Tim writes, first of all, I'd like to say I love the podcast and never miss it. Thanks, Tim. I appreciate it. I appreciate everyone that listens in or tunes in every week and that shares the podcast, leaves a rating, of course, all those sorts of great things. You know, I do put a lot of energy and thought into each and every episode, and it's just wonderful that people are actually enjoying it and getting value from it, and it's something that I really enjoy doing. So thanks, Tim. Anyway, Tim writes, I was wondering if you could do a podcast on the best share broking companies out there in terms of fees and access to different markets and ease of use. Tim, it's a great suggestion. And as I said when I invited questions, I can't promise to write an episode or podcast about every single topic. I don't think I can do one on share trading accounts because we don't really use them very much in our business. And so, when I write something, I like to add something more than what a Google search will do or what other businesses are doing. And so if I'm going to do something like that, I reckon I should have real life experience in them. That said, of course, there's growing options available. BetaShares has a share trading platform, with no brokerage. Now, of course, BetaShares' idea behind that is really customer data. So, of course, they can then start marketing their ETFs to you. But, I guess like any sort of situational or online platform, those sorts of things, we all realize we're the customer, but if we're getting some value from it, that's okay. I also listened to a podcast where the founder of Pearler, Pealer, was talking, and they've actually got some really interesting technology or functionalities, probably a better, more correct term, in terms of automating investing and rebalancing and so forth. So, you can go the cheapest, yes, but I think it's probably going to something that's simple, automated, and, if you can automate your stuff, you don't have to overthink it. And I think it's actually kind of good to do that, where you can sit down in the cold light of day and say, this is the portfolio I would like to design, and then just automate it and resist the temptation of unduly messing with it, which I think can be a problem. For example, if we're in a particularly volatile month and you come to do your monthly investing, will you decide to be a bit too conservative? Those sorts of things. At least if you automate it, that might be a way to go. Actually, Pearler has, just because I Googled it now, has a Google rating of 4.9 based on 278 Google reviews. A pretty good rating. It sounds like a tremendous product and probably worth checking out. So a few tips there, Tim, but unfortunately I can't do a full episode on it. Okay, next question is from Ryan. I feel like we've either answered this question before, a very similar question to it. Ryan's asking about switching investment option in a industry super fund, Host Plus, from balance to growth and whether there's any tax. I've answered the question many times in that it's a pooled super product with daily unit pricing. When they strike the unit price, they net off all taxes. So that is your balance. Whether you switch around, there's not going to be any negative tax consequences with it in a pooled super product. So it's an easy one, Ryan, to answer. So I've answered it many times before, so you can always find a more detailed explanation and answer on the blog on the website. Okay, next question is from Craig, and Craig writes, I'm relatively new listening to your podcast and wanted to say how much I appreciate the insights you share on investing and financial planning. I'm originally from Scotland, where I was always a PAYG employee, and financial education, especially around investing and superannuation, wasn't something I was ever exposed to. When I moved to Australia in 2010, I had no real understanding of the financial system here, but your podcast was my starting point. Since then, my curiosity has driven me to learn as much as possible about tax, finance rules, and investment strategies. It's been incredibly valuable, and I've also passed on your podcast details to friends to help them improve their financial knowledge. I'd love to get your thoughts on my current situation and the best approach to investing for our future. So firstly, Craig, thanks for the lovely feedback. I hope to keep all these episodes really relevant and as simple as possible. because I think building wealth is simple to understand, not always easy to execute. There's lots of things in life that are simple but not easy. And I think finance is one of them. And I think people can sort of get themselves confused. And, there's a lot of businesses out there that kind of overcomplicate it unnecessarily, I think. And what I hope to do is really cut through in this podcast and try and make it as simple as possible. And sometimes going through these scenarios helps me do that. So let's look at Craig's situation. He's 51 and his partner is 52. And moved to Australia in 2010. As he said, with only about $5,000 worth of savings, he would like to retire at age 67. His income is $160,000 plus super and about a $32,000 bonus. Partner's income is $134,000 plus super. He has $625,000 in super, which is a really good start, and helped by the fact that he rolled in some monies from the UK. His partner has $320,000 in super as well, and they're almost fully invested in the share market, so 50% Aussie and 50% in international. His home worth $800,000. Asked me not to really mention the suburb, but I'm not even going to mention the state. Not particularly relevant. Mortgage is $440,000. And then he's got some other assets, car, some small assets in the UK. One child still's got 3 children, but one's still living at home, 24, but most of them independent. And Craig has a side hustle doing some consulting work, hoping to earn about another $15,000 a year. So Craig goes on to say that in terms of surplus investable cash flow, they have about $1,000 to $1,500 a month after factoring in sort of travel expenses. And their main focuses are, growing their wealth, paying off the mortgage, reducing tax liability, all those sorts of things. He mentions that they've considered investing in property, not sure if they have enough time given he'd like to retire in 15 years' time. And even though they consider themselves fairly risk tolerant, currently, Craig's partner is really focused on repaying the mortgage, would like to prioritise that. So his question to me is really, given their situation, what investment strategies would you recommend? And would you prioritise, extra mortgage repayments, a property investment, shares, non-concessional contributions, all those sorts of things? Craig, and I should mention actually something I sort of skimmed over and I just realised that his home loan of $440,000 was refinanced last year and put over a 15-year term. So his minimum repayments will make sure he repays the home loan off over the next 15 years. So, okay, let me respond then to Craig's question. Well, I did some rough calcs and worked out that if Craig maximises his concessional contributions, so that's the $30,000 cap, including his employer contributions, his super balance, if it's 625 today, believe it or not, should be worth $2.4 million in 15 years' time. And if Craig's partner does the same, which they say they're doing, and I assume the surplus cash flow of $1,000 to $1,500 per month is after them doing that, then his partner will have 1.6 million. So that's about 4 million all up together. And both will be under the transfer balance cap if that's indexed between now and then. So really they have $4 million that's tax-free if all they do is just make concessional contributions. And the reason why people might be surprised by those figures, and actually it is kind of surprising, but just as a general rule, it takes a long time to get from $0 to $500,000 inside super. For most people that are higher income earners, really low income earners might not ever get that high, but it takes a long time, most of your career, in fact. But then to go from $500,000 to $1 million typically only takes another sort of 7 years, and then go to $1 million to $2 million takes another 7 years as well. So it really is compounding capital growth, right? The sooner you can get your super balance up high, the more returns will compound and the less important capital contributions are in terms of super contributions. At the beginning, super contributions are really the only thing that's going to push your balance higher. Now, unfortunately, what is the right thing to do at your stage of life isn't, in your 20s, isn't necessarily to maximize super contributions. Of course, you need to build wealth outside super and have that flexibility, but it's important to recognize how powerful super can be in a situation like Craig's. I would argue it's going to do all the heavy lifting. They'll have about $4 million of combined super in 15 years' time. They're put themselves in a situation where they compulsorily have to repay their home loan over the next 15 years as well. So they'll retire with, a lot of super and no home loan. There you go. There's your investment strategy. So what do you do with the extra 1,000 to 1,500 per month? Well, because you, Craig, have said your goal is to retire 15 years, age 67, what I would do is provide for your ability to retire a little bit sooner than that. And so I would probably put that into the home loan. At the moment, by repaying your home loan, let's call it 6%, you're saving. Of course, you need to earn more than 6% before tax inside super, which is really 7.1% in terms of pre-tax returns inside super, to be better off by putting the money into super versus repaying the home loan. Now, it's entirely possible over the next 15 years you'll earn more than 7.1%, but it's pretty close, right, in terms of cost benefit. And of course, the saving in the home loan is risk-free, where there's obviously risk associated with your super earnings. So even if you could get 8% inside super, I don't think it's worth taking the risk. So I would plow all that additional cash flow into repaying your home loan, but not at the cost of reducing concessional contributions. So you and your spouse should contribute, including your employer contributions, 30 grand a year each, 60 going into super in total, and making sure you're in a fund that is going to maximize returns over the next 15 years and minimize fees. And that alone should be enough to sort of get you there. In terms of investment property, this is the challenge, Craig. And for people in Craig's situation or thinking about these sorts of things, the challenge is, if I'm going to invest in property at your age and stage of life, I really want to make sure that the investment is going to work over the next 10 or 15 years. So in order to do that, I've got to really level up on quality. We just can't stomach taking a higher risk and investing in potentially a substandard asset, because it's not going to work and you're not going to get that 15 years back again. You can always make money back into eventually, but you can never get time back. And really the investment strategy requires time. So in your situation then, I'm thinking, okay, well, now we've got to go and invest probably $1 million or more into super so that we can buy the highest quality property possible within relative terms. If I do that, you're going to be relatively highly geared. Your surplus cash flow of 1,000 to 1,500 per month isn't going to be enough to fund that property. So I'm going to have to tell you to reduce your discretionary super contributions, so the bit that takes you up to the 30,000 per year, which will have a negative impact on super. And then you're building a lot of wealth outside of the super environment, whereas I've done the projections that you'll both be under if they keep indexing the cap, under the transfer balance cap, which means you'll have all your investment assets in an entity or an ownership structure that has a zero tax rate at the moment. Now, they could change the tax rate, or they'll probably change the transfer balance cap or something like that. They could muck around with it, but either way, you're not going to pay very much tax at all inside super, potentially nil. So I discount the investment property in your situation. I really think just focusing, given your age and stage is so close to 60, in terms of that tends to be the negative consequence of focusing too heavily on super, is that all your money's tied up. Well, in your situation, that's one of the benefits of being in your 50s, which I'm now in my 50s thanks to December last year. But anyway, that's one of the benefits, is that you can access super, and at least it negates that. So thanks for writing in, Craig. I hope that's helpful and useful, and good luck with it all. Okay, next question is from DJ, and DJ's question is relating to my comments about the Melbourne property market, and that I have suggested that it's primed for a growth cycle. And I talked about that back in episode 303 back in May 24. So for anyone that wants to go back and sort of listen to that episode. Anyway, DJ writes, we live in Brisbane and my daughter just moved to Melbourne to work. So we drove down with her and started our analysis of purchasing a 2-bed, 1-bath apartment in suburbs around Hawthorn. The aim was to purchase and hold for 10 years and wait for the eventual strong capital growth. Our family has been active in property, including investment and development, for the past 30 years, so we knew our way around the market, but had to upskill on the differences in Melbourne. We are keen to assist our children in finding their own property. Key learnings after an active week looking in Melbourne were: most agents had more stock on hand due to investors selling, and first home buyers were the most active group. Using web searches, we were able to compare the asking price of units for sale against 2010, 2015 values and found there had been very little capital growth since 2015. In fact, some prices were below their 2015 levels and close to 2010. Melbourne is more buyer's market, but not for investors. Our calculations found that an average annual land tax cost for a non-Victorian buyer for an investment was between $15,000 and $20,000. This was on a 2-bedroom, 1-bath unit on smaller blocks of units, around 550 to 700,000. This meant that you would be generally guaranteed approximately 3% negative growth per annum due to land tax costs alone. DJ, I'll just highlight that point. If you go and buy a $700,000 apartment, it's very likely the unimproved land value would be maybe, let's call it circa 500, probably less than that. Your land tax cost is then $2,000. There's no higher land tax for non-Victorian owners, so not sure what you're talking about there, but it's about $2,000, still substantial and a lot more than other states. In New South Wales and I think even Queensland, that'd be below the land tax free threshold, so it'd be zero. So not sticking up for Victoria, but the math's a little off there. Anyway, DJ's questions are: on a recent podcast, you highlighted the rise of interstate migration to Victoria by some 650 people, and you commentated that this may be early signs of the market starting to turn around. Can you comment on this based on our results above? Our thoughts are that this segment of the market is still dropping as investors face the reality of holding units with high negative cash flow and will not be turned around by a small number of migration. The next question is it a fact a great market for Victorians and in particular first home buyers? Could the results of the experiment drift to other states if it is an effective in lowering the price of housing in Melbourne with a 4% land tax on any buyers not from Victoria? Again, I'll just ignore that because obviously there's no land tax. So let me go back and sort of commentate on DJ's observations that he shared. It's true, a lot of investment grade properties, those properties that are, kind of heavy land value units typically built, before the 1980s, so 70s, 60s, 50s, 40s. So, those older style units that tend to be a little bit more spacious, really well built, maybe there's between 4 and 8, 10 or so on the block. That's the sort of asset that I'm sort of talking about. I think that's the sort of asset that DJ's been looking at as well. It's true that they're certainly trading at 2015 prices, maybe a little bit more than 2010 prices, but essentially you got 15 years of lost growth there, pretty much. They really haven't done very well. So that observation is correct. Are they still falling in price? No, they're not. They're marginally improving. I haven't seen a massive improvement, although the year's only just begun, but I haven't seen a massive improvement there, but they're certainly not falling. That market's not falling. I was thinking about a related matter recently, yesterday in fact, where it's good to look at the market value of a property, but it's also good to consider its technical value. Warren Buffett says, or it could be Charlie Munger, I can't remember, but he says that, the stock market is a popularity contest in the short term and a weighing machine in the long term, which means the long term, the fundamentals will be priced into the share price. In the short term, share prices can be moved more by sentiment than fundamentals. And I think it's true, particularly in the property market as well. And I'll demonstrate this with the example that I'm using. So if we start thinking about what is the technical value of these apartments, well, we've got to then think about the components that make up the full market value, which is the underlying land value and the improvements, the value of the improvements on that parcel of land Well, we can look at sales of houses and also, importantly, sales of full blocks of apartments in Hawthorn and in other areas surrounding Hawthorn to be able to estimate the value of the land. And I've seen many situations where the value of the land is more than double the value of the units. So if you sum up the value of the individual units, the actual block is worth up to potentially double that amount. And then if you have a look at house sales in the area, we'll definitely show you the per square metre cost of land has certainly risen since 2010 and 2015. Okay, so we know intrinsically that land is worth a lot more. And then you've got to ascribe some value for the improvements on that land, so the block of apartments, and whether you ascribe a huge value there or not doesn't really matter. But it's really clear the technical value is higher than the market value. Then you've got to think about cost to replace. So that is, what would that asset cost me to build today? And we know that, apartments cost a lot more to build than pre-COVID. I mean, some developers are saying 30 or 40%, just with the rising construction costs, to replace that asset is going to cost a lot more money. So the thing is, the technical value is higher of these assets. And I guess that's the opportunity there. It will turn around. There's no doubt about that. The uncertain thing is, when will that change occur? And I liken it to Perth because Perth prices started changing about 2 years ago. So 22, 23, probably closer to 23. But for really between, from 2018 onwards, I was really thinking each year, maybe this is the year Perth starts to enter a new growth cycle. And we were waiting and waiting. We had a lot of clients buy between, or a bunch of clients buy between 2020 and 23. So, that turned out to be perfect timing. But we're really just waiting for that market to turn around. That was a 15-year flat cycle. So I don't know when it will happen, but I know it will definitely happen because the cost to replace those assets, the underlying land value, they're worth a lot more, substantially more than what you're actually going to pay for that property today. The thing around interstate migration wasn't the 625 people, because really if you divide that by 2.4 or whatever is the average number of people that live per dwelling, I think it's something like that. We're not talking about a lot of dwellings. It's not the point. My point really around interstate migration was a change in sentiment. Interesting to see that actually there's been a change in the CoreLogic Daily Pricing Index. It's not, it's only one sort of metric or indication, but that changed early February. So, we don't have a lot of data yet. Who knows if it's going to continue, but there are some sort of green shoot signs of it changing. And then we've got an election in Victoria towards the end of 2026. It'll be interesting to see how Labor fares in the federal election in Victoria in particular. So I think change is afoot in this market. Sentiment is likely to change, and I think that's likely to roll through. But the land tax calculation that you've done, DJ, just go to the SRO website, sro.vic.gov.au, and they've got a calculator there. You'll be able to do your own land tax calculations there. It is prohibitive. It's more than other states, but it's not as much as you've indicated there. Anyway, I hope that sort of commentary. I'm not saying everyone should go and buy a investment grade apartment. I'll put my money where my mouth is. I own a block of investment grade apartments. So, but make your own investment decisions, of course. Okay, next question is from Lachlan. Lachlan writes, I started my business 3 years ago with a mate. I own 47% in my name. He owns 47% in a discretionary trust and 6% is owned by venture capitalists. We might sell the business in the next 2 to 5 years. As a startup, valuations were difficult, but for financial year 24, our revenue was about $10 million with a $1 million EBIT. So we're probably valued around $5 million. Great job there, Lachlan. Business sounds like it's going really well. Business assets, mostly inventory around $2 million, pays himself a salary of $180,000. Here's the complication. From what I understand, I need to transfer my shares into a discretionary trust to reduce the capital gains tax liability upon sale. In hindsight, I should have set up a trust when we incorporated. What's the most tax effective way to sell and exit the business? Are there any novel ways to eliminate capital gains tax? Lachlan, great question. Of course, I remind everyone, none of this information is advice, be it financial, legal, or tax advice. It's really information only. But what I would investigate, Lachlan, is firstly, That should have been a massive red flag for your accountant. And if it wasn't, that's a problem, I would say. I don't want to throw stones at other professionals, but, if someone came to me and said they're going to put the shares in personal name, we would really talk very carefully to that person. Also, it's going to be a problem when you pay dividends out, or if you pay dividends out, and it sounds like you pay yourself a salary, but you haven't mentioned any dividends, even though the company had an EBIT of $1 million. Now, of course, there could be some interest associated with that, but that means you might have retained earnings in the business. Be careful there. Generally, we like to pull retained earnings out of a business. That's not going to be particularly tax effective, though, for you if you own the shares in your personal name. The first thing absolutely you should investigate is transferring those assets into a family trust. You need to have a reason for changing the ownership of the shares other than to obtain a tax benefit, because otherwise that attracts what's called Part 4A, anti-avoidance provisions. The easiest rationale in your situation would be asset protection. So you're transferring the shares into the family trust for greater asset protection in case you ever personally sued. So we can tick that box. And then I would speak to a good accountant. Now, I'm not whether that's your existing accountant or not, to talk about the small business CGT concessions. And there's a few rules around that in terms of whether you're able to meet all the eligibility criteria, but potentially, you could avoid paying any capital gains tax under those provisions, move the shares into, a family trust. And that family trust could have a corporate beneficiary and potentially, cap your tax rate at 25 or 30%, or at least get a credit for the tax that you pay and drip feed that capital gain out. So there could be a lot of ways to save tax, but something you should speak to a really great accountant about. And it is a bit of a red flag that that structure was acceptable, or at least hasn't been addressed either. It's always good to have the best advisors, of course, and just wanted to mention that. So thanks for the question, Lachlan, and all the best with that, and well done on your business. Okay, next question is from JY. Jay writes, first and foremost, I'd like to express my sincere appreciation for your podcast and sharing your expertise with your listeners. A year ago, a friend introduced me to your podcast and I've been hooked ever since. I listen to your episodes while driving, during my free time, before going to bed and even while cooking. I've gained a wealth of knowledge from your insights, and as a result, I feel more confident managing our self-managed super fund. So thanks, JY, and thanks to your friend for referring. It's great to share the podcast, and it can have that potential positive impact. So I'm really thankful that you're able to share that with me. So JY writes, I have a question regarding superannuation recontribution method. I understand that this strategy is typically used to reduce the taxable component of my super, thereby improving the tax outcomes for my beneficiaries, which is correct. The other reason you do a recontribution strategy might be to balance up super between spouses so they stay under the transfer balance cap. But so far, JY is correct. And he continues, however, I'm curious about how this works in practice if I am likely to reach the transfer balance cap by the time I am 60. I plan to stop working at 53 years of age. Does the contribution revert to accumulation phase? Can I still use the recontribution method once the transfer balance cap is reached? If not, could you please recommend the best strategy for reducing the taxable component? A friend of mine suggested using separate super accounts solely for the non-concessional contributions in order to isolate the non-taxable component. When I begin drawing a pension, the idea is to withdraw from my self-managed super fund first, and it holds a combination of taxable and untaxable components, leaving the super account with only the non-concessional component for later. What do you think of this strategy? I have a separate super account which SG goes into, superannuation goes into for now. Once I stop working, I can roll over the funds to the self-managed super fund and keep that account for non-concessional contributions only. Okay, there's a bit in that question. Thanks, JY. And, it sort of highlights how complex superannuation is, and there's a lot of information out there, but I just say be careful, pulling bits and pieces from different sources. sometimes it really is worthwhile just to get some definitive expert advice. And of course, this is not personal advice, but I just thought I'd make that observation. The challenge here for JY is what JY is saying is his total super balance is likely to be more than what's called the transfer balance cap, which is 1.9 million at the moment. It's indexed to wage inflation, I think it is. Well, it rises in 100,000 increments, and it's set to rise to $2 million at 1 July. And, around every 3 years, it rises by $100,000. You can probably just roughly, it will start to compound a bit more than that, but that's kind of how the legislation works at this stage. Of course, it can be changed at any stage. So if JY gets to age 60 with more than $2 million of super, he can't do a recontribution strategy because your concessional cap is zero if your total super balance is greater than your transfer balance cap, which is $2 million. Let's call it $2 million today. Your ability to bring forward super contributions is staged. Okay, so and this is a bit of a planning opportunity, which means I think it's about 1.7 million now if you've got, or 1.67, something like that. If you're below that balance, you can bring forward 3 years of contributions. If you're a little bit above that, it's 2. And then there's another benchmark. But then if you were 1.9 million, which is the transfer balance cap today before 1 July, you can't make any non-concessional contributions. So really to recontribute, to do a recontribution strategy, that's exactly what you need to do, is you need to draw money from super and recontribute it from after-tax dollars. And you just can't do that, JY. For those people that want to accumulate or want to make a bunch of non-concessional contributions, yes, you can put it into a separate account. That will only really be useful, though, I should say, is if you have some beneficiaries in your will that are dependent or interdependent and some beneficiaries that aren't, because then you can leave the account that holds all the non-concessional contributions to the ones that aren't financial beneficiaries. But the chance of that, that could happen in some situations. The probability of that occurring is pretty low, right? Because most people, when they pass, their children will be independent adults, in which case there's no real benefit because the estate will end up paying, or the beneficiaries end up paying broadly the same tax anyway, because it's only levied on the proportion of those balances. So it doesn't really serve a great benefit necessarily, and it just depends on your estate. Again, it shows how complex this stuff is, right? And, again, you got to try and make sure that you're looking at all the right rules and data. But thanks so much for your question, JY, and thanks for everyone's question. Of course, if you have any more questions, do send them in. I'm even thinking about or contemplating adding a third episode a week. I'm not sure if that's going to be too much Stuart Weems in 1 week, but I'm contemplating doing that just so I can get through more of these questions because they are fantastic. Anyway, we'll see how we go with that, and I might just leave it there for today. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.